Good morning. This is Ken Long from Tortoise Capital with a review of the weekend trading report for March 4th, 2017. Market is in bullish normal conditions on an annual basis using weekly RSI 14. We are overbought at 78 out of 100. On a 10-day basis using the 10-day NDX, we are at the high end of neutral at 70 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is green bullish at 9.7%. Slope of the 50 is white bullish at 0.56. The ADX is showing a strong bullish trend at 42.9. That is so high that it's hard for the market to maintain that level of trendiness. And so we are concerned about ensuring that we've locked in the gains from these relative strength leaders, and I'm reluctant to add new positions at this point. I'm more concerned about managing the ones that I have. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold between risk on and risk off is 1.0. The current reading is at 0.974, so we've moved into risk off conditions. This reinforces my opinion and my posture about being reluctant to add new swing positions. You can see the risk Z is when we take that score of 0.974, compare it to the last 5,000 trading days, and find the average of the standard deviation. We compute the risk Z. That's at minus 0.39. That's minus 0.39 standard deviations below the long-term average. You can see a 90-day histogram of that indicator here. When it's in the red, we are cautious about being vulnerable to volatility spikes. The fact that it's starting to tick up a little bit, however, is the beginnings of a favorable sign. So if that's as low as it got, we'd see this as a favorable divergence here. But because we've been vulnerable to volatility throughout this long period of declining volatility, this still has me concerned right now. So again, I'm managing positions rather than starting new ones. In the blended monthly rebalancing, you can see the candidates for March, which will hold until reevaluating around 1 April, and then the leaders based on Friday's closing prices. ETF2 is at 100% exposed in the theoretical model, and the model portfolio itself is at 100%. These are the leaders of the ETF 13 and 32 portfolios in that BMR system. Again, you see most are on buy signals, being better than their 4-month moving average, and then with the leaders on the blend noted at the top. Financials, Brazil, and emerging Europe actually doing very well right now. In the ETF Max, we're looking at the symbols that have had the greatest performance out of the entire database. There's been some extraordinary moves. There are also some big pullbacks. And so when I look for extremes in this report, I'm looking for greens across the board and looking for the possibility of additional momentum plays. The ones that are in the red are ones that were formerly leaders, actually still are leaders, but have had a significant pullback. And so uranium, as an example, might be something that's been exceptional, but has offered a sharp pullback. The other explanation here is that the outsized performance is over. Now this is a reversion to the mean trade, so I would also be framing this to look for potential momentum to bring it back to normal, i.e. losing some more. In the S&P 500, we're looking at leaders in, CSX, NRG. Energy, some potential momentum there. Micron had a great week, as did Bank of America in the financial sector, so that could be an area where if you saw the market up and financials doing better, you would want to look at Bank of America to see if that was still outperforming even the sector, and then that would be the lowest risk trade of all. In the market health check, we had this long period of sideways quiet channel. It broke to the upside here, had the first leg up. I consider this move here over that about 15 days a short pullback, and then another second leg up, not quite as strong as the first leg up, and it's pulled back for a couple days, but I'm careful and cautiously optimistic here. We have the dragon has pulled out of the river, and it's been guiding that price action northward. You see the slope of the 30 and the 10 are both up. A target to the downside, if the support at the bottom of the dragon or the edge of the river doesn't hit, would be the Bollinger Band mean, or the middle of the river around 232. The bottom of the river, bottom of the floodplain, and then the bottom of the Z3 line, which would invalidate this entire two-leg move up here. So still cautiously optimistic. I'm still maintaining positions in the relative strength winners, but I'm not adding new positions at this time. I'm looking at those relative strength winners as intraday trading opportunities to add more, or if they start showing some weakness, to get short so I can hedge the long side position. ETF regional report, all of the regions are above their 4-month moving average, so they're all on buy signals. That keeps us at 100% invested, 0% cash in the allocation model. With the market in bullish normal and the S&P at 42, better than EFA at 39. The strength is still in the U.S. Inside the U.S., it's technology, then large caps, then the mid and the small caps. The two strongest sectors, Latin America and U.S. tech. Two weakest sectors are Japan and Asia, less Japan. The Euro-Asia blend, EFA. Inside the sector spiders for the U.S., strength in financials and technology, energy lagging significantly, and materials lagging as well. In the world market model, most of the U.S. is above average, NASDAQ 100 exceptionally so. Only the small cap value lagging the database itself. Latin American emerging markets above average. Brazil has come back into a position of dominance. You see that the finance and tech strength is not just a U.S. phenomenon, it's a global phenomenon. Strong dollar is still in play. China, Australia, Asia less Japan above average, but some weakness in Philippines, Indonesia, and Vietnam. ETF top 30 using the ETF2 lens. Again, financials, Brazil, biotech, and technology leading the way. Inside the Dow 30, Apple, Boeing, Goldman, and Morgan at the top of the stack. At the bottom of the stack, in the red for strength, ExxonMobil, GE, Walmart, Verizon. These would all be plays where I might be looking for bottoming action to occur and looking to buy some value. In the ETF liquidity, again, you're looking at those symbols that on the basis of an average 30-day dollar volume and their ATR percentage, those in the green are exceptionally good for intraday trading, and the ones in the red not so much. Shifting now to the daily for Monday, we have no overreaction and channeling signals in the primaries. You can see just how quiet that volatility has gotten, and the extreme strength of trend in the ADX near very nosebleed levels of height here. A handful of good 551Ws and auto framer candidates to work with, and a couple 5DDs for that matter. Starting to see some frog quality numbers getting above 3.0 now. Intel is worth looking at because of the 5DD. It's number 2 on the max pain range compression and has a great frog quality number. Frog quality number 2.8, and has a 2 on the RSI 2. So here's a quick look at Intel. You can see it's a 5-day down narrowly. It has 2 higher lows, been very tight, narrow ranges, resting on support at the bottom of the river. Our entry would be, if we're playing this as a 5DD, around 36.10. We would have a stop below the swing low. Looking at the upside, we would want to see it get through the top of the dragon, at 36.50. That'd be the first place that we would start feeling comfortable about that trade. Next top of the dragon, notice over here, we're looking for 37.50, and then a final target at fair value at the RL 270, right around 38. And so in terms of risk and reward, you're looking at about 75 cents of initial risk, and then going from 36.10 to 38, $2. So anywhere from almost 3 to 1 in that reasonable move. Would we play this on the short side? We absolutely would. I would be willing intraday to go short at 35.75, with the idea being that we've got a high in the dragon and the baby dragon, a lower high. The RL10 has already crossed through the dragon. It's at the bottom of the river. So if it were to fall out of the river here and break this 2-day low, I'd be ready to get short here. And then if it breaks through this Z3 line, notice over here, basically if it gets out of Z minus 2, you'd be well into the money, and then only one final support at 34.80. And then if that breaks down, you have a very nice short. So this is the case where a 5-day down failure is something that I would like. And then we'd see the next level of support is way back here at the belly of the dragon around 34.50. So you have a nice set of targets to the downside. Back to the daily report, inside the ETF 30, we have a number of 551W candidates to work with here. I like that one because you're buying the second day's worth of momentum. And so these symbols here, treasuries and emerging markets, I like because they have favorable auto framer reward to risks. I also like Brazil because we've seen that as a sector strength or regional strength. It was up 3% on Friday, and it's still number 2 in the max pain range compression. So I really like that as a target. Let's take a look at Brazil, and then we'll also take a look at metals and mining, number 1 in the auto framer and max pain range compression, and has been very good on both intraday and swing trades. So we're going to look at XME and Brazil next. So this is Brazil, EWZ. I really like this pattern. We have the river is up. The dragon has been comfortably on the north shore of the river all the way up, but there's been now a pullback after a series of increasing highs, where it's now finding support at what once was resistance and then became support once again. So if it were to hold at 37.60, that would not be surprising because it held here for 10 days in a row and then moved from 37.60 all the way to 41. So really that's almost $3.50 of upside gain. And you can see that if we went with a mechanical entry 5 cents above Friday's close and using the swing low or even the daily low as a target, we can, by inspection, you can see we have 2 to 1 to the upside. If this were to fail, however, below 37.50-ish, so we'll put this as the red line, then my target to the downside would be Z2, then Z3, and then finally the next support level down here at 32. So there's room for this to work on the downside as well. That puts it in a critical state, one where we pay only a little bit of price for information, either to get an upside move or a downside move. Because of the resurgence in Brazil, this is going to be a high payoff. If we look back a little deeper, you can see that we've recovered all of that price that ended up bringing it back to 17. It's remounted nicely. This is an important support level here. You can see it peaked here before, and when it failed there before, you can see that we ended up getting short inside on this leg down, and then an owl move on the upside. So what we have is a really important support level here around 37-ish, 37 and a half, and we're going to test to see if it can make this move. If it can make that move, it can certainly get above 41. If it gets above 41, it's free and clear, and then we would take the estimate of future of a future price in the following way. We would come over here to the previous maximum divergence from the RL270. That's that green that's that green square. Let's zoom in a little bit so we can see that. So we're measuring the difference between the RL270 and the RL10. So just plunk that on there. And then were we to get an excursion to the upside, it went down this far, it can overreact to the far side in the same way. This would suggest a price of around, 44.50 is within reason. And even if we take the last favorable excursion, this one right here, and we get a smaller estimate, even so, that's an attractive 42.50. So there's room to the upside on this one, and a few measurable spots where we could manage the trade. But then if we get failure out of here, then this would end up being an owl pattern to the downside with price targets here, here, and here. So I like this as EWZ being in a critical state with a favorable move available in either direction. So let's take a look at, I think it was Treasuries next. All right, for our last symbol, Treasuries, you can see, have been stuck in this sideways chop. While the market has been doing very well, it's been finding significant support here around 119. And this was the response to the Trump bump here, where equities took off, and that was money coming out of Treasuries into equities. But now it's been stabilized here, so this is pretty strong support. If I would want to see price clear the top of the dragon. Let's zoom in a little bit so you can see that. I would want to see above the top of the dragon, really in Z+1, with a stop down here. And in my view, price has to get through this 122 and a quarter ish range. Maybe we could even bring that lower to the top of the baby dragon, say 122.50. And really the RL270 for fair value. If it can do that, then that would signal a shift in the regime, and then I would see the next target as being closure of this gap up around 131. So there are some tactical reasons why this is not a bad entry, even where it is, because you're buying in the bottom of a channel at the support level, and so your risk is relatively low. So as an initial position, I don't even mind buying it right here, right now, and making this entry, and then risking only a small amount. And then were it to get above the baby dragon, then you're already using market's money to get well. So I actually like an entry right in at this price level now. And now we set up a very favorable target. Even if it goes up just to test this previous swing high here, then you've got almost a 1, 2, 3, nearly 4 to 1 reward to risk ratio. So that's a low risk idea. And then were this to fail, you've got some downside support. Your target down here would be 116. You would see a tremendous move in the equities, the next leg up in the equities continuing if Treasuries were to fail here. So I like Treasuries entering at this level on a tactical and at a longer term swing basis as well. Okay, back to the daily. We've got some auto framer targets already pre-framed out for you. You can see XME, Treasuries, emerging markets in Brazil already mapped into there, and their reward to risk ratios on a swing basis. The regression line fractals continue to give us insights into the relative strength of leaders and laggards on a longer term basis. And the daily squeezes, lots to choose from in here. There's Monsanto, Amazon, Google, and Halliburton available. Amazon should be of interest. 30-day regression line, remarkably steep up now. You can see that we're 1.5 standard deviations above the long-term average here, although it's starting to collapse a little bit. That also suggests to me that reinforces the information coming from ADX, which said that we're in exceptionally strong posture and not to be initiating swing trades at this location. If we think back to what I was talking about in Treasuries, that's actually a counter trade swing, the first position of a swing in the other direction, which you can see why now that could be attractive. Just flipping through the other ones for reference. You can stop the tape and look at it if you need to. These yellow indicators here at the 5 and 10 days are evidence that the Trump bump is slowing down a little bit, as it's starting to underperform on 5 and 10 days. You can see the extent of this very nice move is now as long as the sideways quiet channel was leading into the election. You can see that the 90 regression line slope is almost 2 standard deviations. Very hard to sustain that long term. A cooling off period would not be unusual. You can see that the 30 has gotten as steep as it has the last 2 times it failed. So the last time it was here, this downward sloping was a long period of consolidation that brought it back to normal. This one was after a nice bump from the previous bump, was also another long period of slow consolidation before it found support. So that would be the least surprising event, where it just to kind of go sideways around 235 to 230 and drift backwards. And that's everything I want to cover from the daily and the weekend report. This is Ken Long at Tortoise Capital. Keep your risk measured and your powder dry.